Ladies and gentlemen, we are back once again, this time with a new setup, a new background. I hope you like it. I put out a poll on my YouTube channel asking if people would like a third investment analyst reviews investing TikToks video, and I got a resounding sure. If you're new to the channel, my name is Richard Coffin. I'm an investment analyst and a registered portfolio manager. I'm going to take some time today to review some different investing TikToks. And I will try to make this educational, try to provide some points of clarification and explain some things further in detail than what you get with these quick videos, just to give some clarity around the more gray area stuff. So without further ado, let's hop into it.
This is huge news. Google just announced a 20-for-1 split for their stock. That's bigger than Tesla, bigger than Apple. This means that for every one Google stock in existence, there's now going to be 20. That means that the price is going to go from $3,000 all the way down to about $150 a share. Now, historically, in the past, whenever a big company has done this, what happens is that the price of that stock goes down because of the split, but then it quickly rises back up. So I can expect Google to double here in the next 3 to 6 months. Now, it's one of the biggest opportunities in stock that's probably going to happen this year. Now, for those of you who missed the Tesla split, for those of you who missed the Apple split, this is your chance to get it on this stock before it rapidly rises.
So I've seen a few videos circulate now talking about stock splits and how, they lead to this sort of rally in the stock's price. And initially a stock split is kind of an arbitrary thing, right? It doesn't really matter how many shares you divide a company's value over. At the end of the day, the company's value doesn't change. It doesn't have any intrinsic impact on the company's value. But people do believe that stock splits lead to this, rally afterwards because it increases accessibility to the stock. You have all of a sudden these people who couldn't afford the share beforehand, Google's a $3,000 share roughly, now they can afford these shares because, they don't need to spend $3,000. But I think people are blowing out of proportion how material of a change this will be. It's not like the floodgates are going to open and all these new investors that weren't previously buying Google are going to start buying the stock. You have to remember that we already have things like fractional shares, which basically let people invest as much money as they want to into companies like Google. So people who wanted to own Google already had methods of owning Google and probably already did own Google. And it's not to say that Google's not going to see a positive impact there, but Google is a $1.5 trillion company. So if we see that company double, all thanks to a share split, you're effectively saying that it's going to become larger than the country of Canada, all thanks to an arbitrary accounting change. And I know people like to look at Apple and Tesla, which are two examples of companies that did stock splits and then saw their stock price rally afterwards. But that's two companies, right? That's not nearly enough to prove a relationship here. And, if you can't count on your fingers other companies that have seen kind of a stock price rally as a result of a stock split, I don't think you should, believe that that's a statistically significant relationship. Two companies isn't going to cut it for an investment thesis.
I just found a glitch in the stock market. So you want to go to TradingView, pick any stock like AMC, and choose the Heiken Ashy candles. Whenever the candles make a flat bottom, like right here, you want to get calls. And when it makes a flat top, get puts. Don't believe me? Try it out yourself.
I can appreciate his enthusiasm. He's more excited about this than I am. So this is more technical analysis, which was really popular on TikTok, where you decide what stocks to buy and sell based on what the price has done and the patterns they're in. Here he's talking about candlesticks, and when it's flat, it's a buy or whatever. The problem with technicals, and especially this kind of oversimplified use of it, because I do think that you can use technicals as part of kind of a bigger basket of things. Technicals in this kind of fashion really are the astrology of finance. And I know that will likely offend some people, but there's really no research or any reason to believe that these things hold any water. And it really just operates on the idea that things move in patterns. But the problem there is that, people like to superimpose patterns onto data sets where that pattern doesn't actually exist. It's just part of the human brain to kind of look for those cognitive shortcuts and identify patterns to make, processing information easy. There's actually a great part in the book, A Random Walk Down Wall Street, where the author talks about this experiment where a coin is flipped a bunch of times and a fictional stock price is moved up or down based on the heads or tails result, leading to a sort of fake historical price chart that's totally random, if you will. And the funny thing is that this chart was handed around to different technical analysts, and a lot of people gave very positive kind of reviews and conclusions about this totally randomized price chart that wasn't real, and apparently became very upset when they found out that they had been got. But it just goes to show, people like to look for patterns in things. It doesn't mean they necessarily exist. Start with Roku. Jeez. Oh my God. All right, we got Tesla. Okay. All right, so obviously not the best performing portfolio, but I do think that you should judge someone's merit off of not only kind of the long-term price performance of their position, so here we're only focusing on the short term, but also on the merit or the work they put into the analysis and the supporting research. And that's something you really don't see on TikTok. You see all these, focusing on the picks that people did, very little focus on the research they did to, come to that conclusion. It's just, I knew what I was doing, so I picked this stock. And I think that's a really easy way to sift through the bad research or the bad stock picks out there, is to just ask, what is the supporting research there? And is it enough to get a passing grade for a high school assignment? And if the answer is no, if someone's only given you very high level industry information or basic stuff about the company, then it's obviously not worth investing into. In this case, it does kind of seem like this guy just bought a bunch of hyped positions, put them into a portfolio and hoped that it would turn out well and make him look like a genius, and suffered the consequences of doing just that.
Max out your 401k could be the dumbest advice that I've ever heard for anyone that wants to take financial control of their future. Why?
Yeah,
well,
why?
Chris, it's free money. You do max contribution and the company matches you. It's awesome. Are you kidding me? First of all, I give you my money and I'm never gonna see it for decades. Why would I give that to you even if you're matching it? It's not real, it's fake funny money. I can't use it, I can't invest it, I can't do anything with it. And it's on the roller coaster of the stock market, which means that I'm gonna be averaging 3-4% on my money. Now, by the way, just so you know, when inflation is 3%, which is what the value of your dollar is losing every year, and you're gaining 4%, 4 minus 3 means that you're netting 1%. Let that compound over the next 30 years, and you're gonna be happy with it turning into a pile of nothing. Poof.
Have something. It's not often you have someone so aggressively wrong about something. So first of all, he seems to be anti-stock market. He only talks about earning 3 to 4%, which is kind of weird because, historically, the S&P 500 has achieved an average of roughly 10% over the long term. So that's kind of a low ballpark to assume that you'll get from stock investing. Now, there are some valid criticisms of the 401k. On the one hand, you can't really access your money until you retire unless you meet certain circumstances. And secondly, from my understanding, given that, I'm Canadian, it sounds like your employer decides what your investment options within that account is, and most of the time you just end up having a short list of certain mutual funds to invest in. So you might not necessarily be able to invest that money that's in that account in the investments you want to. But there are benefits to the 401k. On the one hand, not only do you get a tax refund for money that you contribute to the account, but it gets to grow in the account tax deferred, right? So that means more compounding. And it means that overall your money will grow faster than if it was outside the account. And if your employer is matching your contributions, really that's a free, immediate 100% return on the money you put into your account. So I really don't get I don't get it. I don't know. I guess it's just about saying stuff confidently enough, right? That's my problem. I'm too tired. I gotta find a balance between belittling my audience and that Fortnite streamer voice from earlier.
I just found a glitch in the stock market.
Hey guys, what's up? I can't do it. Obviously, they left out the most promising NFT collection of all, the Bagel Butt collection, which is live now on theplainbagel.com if you want to go buy a Bagel Butt. Just kidding, it's a gig. I don't have a lot to add to NFTs.
Okay, so you want to invest when you're 15, but you don't know how?
Yeah, actually.
Okay, well, you're going to want to open up a custodial account.
What does that do?
This allows you to invest under your parents.
Okay, where should I go to do this?
TD Ameritrade.
Thanks, Taylor.
So no inherently bad information, and this person's actually put out a few TikToks I've seen, and I think, she focuses on pretty basic stuff, nothing offensive in that regard. But what I will say is that if you're a kid, if you're 15 years old, there's really more important things to focus on than investing. When you're that young, you obviously don't have that much money to invest in the stock market. You're more likely to get a much better return for your effort on things like focusing on your education, on getting a good job, and, getting a good salary, or, sure, if you want to start a business or whatever it is, focusing on the actual income generation than just getting investment returns when you don't have any money. Now, if you want to focus on money management early, that's great. And I think, no one would argue that it's a bad time to focus on spending habits and investing your money. That's all fine and dandy. But especially if you start to look into stock research and stuff, it's really too early for that kind of thing. And, there's passive investing, sure, but when it comes to stock picking, you do have to be educated. You have to have a solid accounting background. You have to understand markets and the economy and all these factors, which at that age, you just probably don't have that good of a grasp on. And if you can't tell me about, depreciation, working capital, how taxes work, and just, fundamental stuff like that, then you're far from at a point where you should be doing your own research. It's not to gatekeep, it's just to set expectations, right? You shouldn't be researching and buying your own stocks if you don't know the fundamentals. It's just that simple.
Bro, wake up!
Oh my God, that laugh.
Bro, wake up!
Okay, I'm sorry. Let's continue.
There's one way that people got rich for decades, and you know damn well that it wasn't from a college degree, man. The same way that I got this $1 billion view, and you haven't even started yet, man. Come on, let me guess, bro. You don't know what to invest.
A lot of emojis.
Come with me. Let's make sure you don't get left behind.
Maybe he should have gone to college. He'd know what a diploma looks like. So we're ending on a strong one, but I will say, obviously, everyone should strive to invest. I think that's pretty sound advice that you should try to get to a point where you're able to invest. But, not for these reasons. That's really not the point of investing. Outside the fact that the richest people in the world got there through, creating businesses and starting ventures, not, through Robinhood day trading. But, outside of that, the people who have actually made it, who actually have this type of wealth, they aren't like this. No one acts like this, having worked their way to this sort of positions. The people who act like this are salesmen. This is a sales tactic. It's trying to make you feel bad, feel uncomfortable, and they're giving you a solution. In this case, this guy has a course where he'll show you how to get this $1 billion view. So yes, you should learn about investing. You should learn about managing your money, but not from this guy. Everyone has their own pace, everyone has their own risk tolerance, and you shouldn't be made to feel bad about the type of investing you do. Just make sure that you're doing the best you can and trying to be diligent with your money. It's your life savings. If you need help, you can reach out to a professional, not someone on TikTok who's, selling a course. And I don't think I really even have to say this stuff because I think it's pretty obvious. It's pretty brutal. So this has been Investing Analyst Reviews Investing TikToks Part 3. I hope you enjoyed it. I hope you maybe learned something. And if you did, please do make sure to like, subscribe, and all that good stuff. It really does help the channel tremendously. I don't know if I'll do many other videos like this. They're actually cracking down on finance TikTok videos, which, thank God. But I'd be interested to hear your thoughts in the comments down below. What you thought of this and what your thoughts were on the different TikToks we reviewed today, and what your takeaways were. Thank you for joining me today. And as always, be safe out there.